Welcome, everyone. Another edition of Back and Forth with Becker and Orr. We are ready to go. You can see the topics on the bottom of the screen there. The lead-off topic, hedge fund Archegos Implosion. How did that hurt the market? We're going to get through it. Lots of topics to tackle here, Kevin.
Yeah, we are. We're going to do that. Again, if you want to see more of these videos, please go to our website at beckerorr.com or find our YouTube channel or like us on Facebook. We're always there to ask about it. And as you mentioned, we're going to deal with the hedge fund scenario first. You call it Archego. I could call it Archego. One of these days, we're going to figure out which one is best. So why don't you lead us off into what's gone on in the last week?
Yeah, I mean, the whole story here, it goes back a number of years. Bill Huang, whatever you want to call the hedge fund, that was the guy running the show there, Bill Huang. And he had phenomenal returns. He averaged 900% across 7 years. He was going almost 40% per year, but concentrated positions. He had lots of leverage. Apparently, he was levered about 8-for-1. So if he had $1 billion, he was invested about $8 billion. So significant. And then over the last few weeks, essentially, it worked against him, and he had to close all those positions, and he had an implosion there because all the leverage worked the other way. You get big gains on the way up, but you also get huge losses on the way down. And what's on the screen is one of the securities that was hurt by this hedge fund implosion, Viacom. You can see it was up about 170%, and this is only year to date. This is only from January 1st until end of last week. And then the implosion that followed, where it dropped about 90% in the span of a couple of days. And we saw this in a couple of securities. Viacom was one, Tencent Music, Baidu, Discovery. There are a handful of names. All these positions were the ones that Bill Huang held. And then he had to sell, so you had a mass amount of selling here. And people were worried, Kevin, all that leverage, all that selling, could this hit the markets? And what's your take? Is this something to worry about, or is this isolated?
No, I mean, basically, I think this is more of an isolated incident. And as you mentioned, I mean, you got Viacom, you mentioned Tencent Music, you mentioned Discovery. I mean, they were all media scenarios, all media stocks that came around. And basically, I mean, with the hedge imploding, should I say, a lot of people figured that, okay, this happened on a Friday. Come Monday, the market's just going to get wrecked and everything else. But a lot of the people who did the leveraging and things along that line managed to get out. I mean, Goldman Sachs and JP Morgan were relatively unscathed with this entire thing. They managed to unwind their positions. And at the end of the day, when people saw that on Monday morning, really it had no effect on the markets whatsoever. So similar to the GameStop scenario, which was earlier this year, and we saw sort of a hedge fund implosion, they seem to be isolated incidents right now, and they're not having a huge effect on the market. I guess if you get 5 or 6 of these to happen at once, maybe it'll have a little bit more play. But at this point in time, I think that it's going to be relatively minor. It'll be something to watch. It'll be something that people will talk about. But I think it's going to disappear quite a lot.
And you hit the nail on the head there. You hit the nail on the head with the banks there. Goldman Sachs unscathed. Credit Suisse, however, not unscathed. They came out with a $4.7 billion loss. That's what people were worried about, saying, all right, the hedge fund implodes, but then all the big banks take a hit. Now you get this kind of spillage into other sectors. And if the exception of Credit Suisse, the other ones kind of came out unscathed and are doing fine. And overall, the market continued to move forward. So likely not going to be the implosion, likely not going to be a big hit to the market. But another big story here, Kevin, we're going to talk about. Why don't you lead us in? The big infrastructure spend, the $2 trillion.
Joe Biden was in Pittsburgh last week and unveiled his $2 billion plan. And I mean, there's a lot of contingencies to this. They want to do roads. They want to do bridges. I mean, they want to do the traditional infrastructure, but they're also talking electric charging stations. They're talking broadband for all. So, I mean, as opposed to just your traditional infrastructure stuff, they are looking at a variety of things. And not only that, but they're also looking to raise the tax corporately from 21 to 28% to pay for it. Now, you will probably get a lot of the Democrats to go along, but I think this is going to be a whole bipartisan scenario. Republicans do not want this. The traditional infrastructure, sure, but broadband for all, not something they're dealing with. And you also got to worry about the centrist Democrats that you have to please. I think we're going to have a little bit of play here. This will not be the final number. This will not be the final plan that's put out. I can guarantee it.
Yeah, I agree. I mean, they made a big announcement, $2 trillion. And some of the numbers here, you can see spending only about $620 billion. Only, that's kind of scary. Only $620 billion of the $2 trillion. And what we'll call traditional infrastructure, bridges, roads, that kind of stuff. And then lots more for electronic charging stations, for broadband, for upgrades to the power grid, for clean electricity. So that's part of the issue is Republicans and Democrats don't seem to agree on what the word infrastructure means. So you have these different items. And then the tax increase is pretty much a non-starter on the Republican side. You've already seen some of the centrist Democrats, Joe Manchin out of West Virginia, for example. He's already come out and said, I don't like it. I don't like the tax increase. So I agree with you. There's probably going to be some give and take. This is likely not the final version. But do you think a version of this gets through? Do you think they get a bill done?
Yeah, I think they will put something through, because at the end of the day, it's going to be the same thing that went with the 1.9 trillion that he just put through for the stimulus package. It voted along party lines. So what's going to happen, I think, is you're going to have to give a little bit of give and take to get those centrist Democrats on, and then they'll shove it through. I mean, as opposed to the far right or the far left, I mean, the far left tends to vote along with what's gone on from here. And yeah. I think it's kind of amazing when you take a look at this, that we're talking about a $2 trillion plan, and people are going to argue over probably $100 billion one way or another. Whereas we had one hell of a time trying to pass $700 billion back in 2008. I mean, we're more than double that amount, and the numbers just, they amaze me where it goes. But yeah, I honestly believe this will get through in some version. Probably not till summer, though.
Oh, okay, I got a time frame for the summer, and that matters for the markets when it gets through, when the spending hits. But I think you would see a revving up of the economy, because that's a lot of money going into the economy on top of what's already in there. And I think the market's going to react to that too. So we could see, whenever this gets the announcement and an official bill, you could see a bit of a pop in the markets. That's my take.
I agree. That's exactly what should be happening, and we'll have to wait from there. But moving on from that, as you can see, monsters dominate this weekend. Here we are with Godzilla versus Kong. Now, I got to admit, I'm a bit of a monster movie fan. I enjoy this. I do want to see it at the theater. Stuck in Winnipeg, of course, I can't, because they're not open. And I don't know, watching it on my big screen TV isn't the same as being in the theater itself. But that number that you see right there, 200 million worldwide. I mean, that's bigger than any of the other ones for the first opening weekend. It's amazing. I cannot believe what's going on. But that will lead us to that same scenario. Are we dealing with people going back to the theater to watch, or is this an anomaly? What do you think?
I'm not sure. I think what we're going to deal with here is more towards the anomaly situation, where you have a couple of big movies. People are willing to go see it. They want the spectacle. In this case, they want the big screen, the big sound for the big action movie. And it's important to mention the numbers are 200 million. Half of that, about 100 million, came from China, where they have more movie theaters open. So it makes a bit of sense. And the last time you had a movie, a factoid for you here, Kevin, last time you had a movie do 100 million in China over an opening weekend was Frozen 2 back in 2019. So pre-pandemic numbers here for the monster movie. But I think if you think about theaters, you had some issues with theaters prior. They were already struggling before the pandemic. They're trying to attract people, and they're going VIP. They're going to big loungers. They're going to have more of an experience. And I still think they're going to have tough competition even when we're out of the pandemic. So I think this maybe gives a glimmer of hope for your big blockbusters, but doesn't mean people come back in droves. That's my take on it. What do you think?
Yeah, it could easily be that one. And I think the China thing is probably, I mean, I know Godzilla technically is Japanese, but the Chinese are probably owning him as a hometown hero. So that's why we got to go see him. See if he can beat the American Kong. Okay, I shouldn't be doing it that way, but who knows the way they play it. But yeah, I think that's probably it. And the other factor with this is, I mean, the humans in this movie, from what I understand, are basically just bit parts. So, I mean, maybe that's the thing. The more CGI you use, the more that you have some of those nuances as to the way they're making movies nowadays will probably be bigger going forward. So, yeah, I'd hasten to say that the movie industry was in a bit of a problem beforehand, probably will be in a bit of problem afterwards, at least until that time. And you're right, you're going to need an absolute blockbuster to draw everybody in. That's about the only way I can see it going.
Yeah, too much competition. We have so much demanding our attention nowadays, and you've got all the streaming services, all these different experiences. It's hard to get a big audience back into a movie theater unless you have that big blockbuster. So I'm not sure if that's going to change, even when they do open all the theaters.
Yeah, and I guess the last point on that sort of scenario, if I have to mention, is the fact that it seems that every movie studio nowadays owns some form of streaming service, so they can put it right on there immediately. So I mean, there's no point in saying, you know, they're owned by Disney, they're owned by Paramount, they're owned by MGM, and they're not going to show them to you online. Right now, they're doing the same thing. So, I mean, a lot of people just say, well, what's the point? I can just pay my $20 or whatever and watch the movie from here.
That's true. That's true. Well, it leads us to the question of the week here, Kevin, and this is a very topical question. Interest rates are always, well, they've been going down recently, but what do you do? If someone's going to be buying a house, do they go variable? Do they go fixed? What's your opinion on interest rates?
Well, if I have to look at it, I mean, for the next little while, I think interest rates are going to be fairly low. I mean, you've had the Fed come out. You've had basically global governments saying they don't want to touch anything if they can till 2023. But I mean, that leads to the big question of, do you do variable or fixed? If we take a look at it on a traditional basis, fixed rate mortgages are 2-to-1 over variable. And I think the main reason for that one is it's a security thing. When you're dealing with, wanting to pay your debt down, if you know that it's 2.9% a year for the next 5 years, that gives you that feeling of safety and security. Whereas, if you're paying 1.8, yeah, that's great. I love it. But if rates start to go up, what am I going to do? So, historically, I think variable does much better for you over the long term. But I think that security thing has a big bearing on what it is. And I think you're going to get more fixed rate mortgages going forward regardless. We've already seen a little bit of an uptake. So what do you think is there?
Yeah, if you look at the variable rates, in the last 2 decades, variable has been the winner. Rates have consistently gone down, with the exception in the 80s, there were rates peaked and you had some really high mortgage rates. But with the exception of that, since then, rates have really only gone one direction. There's been a few odd rallies where it goes against us, but for the most part, rates have dropped and that variable mortgage has been the winner. But I agree with you. It's not necessarily about getting the lowest rate. There's a matter of security there, right? There's a matter of knowing what your payments are. You can plan around it, and you've locked in your rate. Now, one thing to consider, if rates are quite low, perhaps you can start with a variable, and often mortgages allow you to lock in down the road. Because as we said, I don't think rates are going up in the near term. So you could have that variable, you can get the lower rate, and you could still have the option to lock in down the road if you think rates are going to spike.
Yeah, that's the biggest one. That's the best way to probably play it for everybody. But again, the banks, they prefer to lock you in now because they get a lot more out of it. The interest bank is there. You're talking on a 5-year, probably anywhere between 2 and 3% spread. So if they can lock you in at 5 years, they know they've got a guaranteed income coming in, because we know they're not paying it out on GICs. So they want to make as much profit as they can. That's their bread and butter. And I also think that's another reason that you get more of a fixed rate as opposed to a variable rate. But you're right. Variable should be the way to go for most people, and at least to start until you start to see your rate moves up. So other than that, I think I've finished my view on mortgage rates. How about you?
There you go. That's good. Yeah, we covered it well. And if you have a question you want us to tackle, let us know. You can see the bottom of the screen there, chat with Clinton and Kevin. That's part of our website. There's a form there. You can ask us any question you like. We'd be happy to tackle it. Happy to help out. Any parting questions for the folks, Kevin?
No questions. I want the theaters open next Friday so I can go and see what this Kong thing is all about, whether I should be watching it at home or whether I want to go back to the theater. That's it.
There we go. We'll give people an update next time. So until then, everyone stay safe. Take care.